economy will surprise people. I think there'll be a cut in the capital gains tax rate coming out of Washington, some movement on deficit reduction, and a strong U.S. dollar. I think all of that is going to keep the U.S. market up.
I think one of the reasons we've had no 10% corrections for 6 years is the stock market, but particularly the bond market, been very adept at seeing excesses beginning to develop in the economy or the marketplaces and very quickly wringing them out.
We wouldn't read too much into the market's activity over the last few days. You had great 1995, great 1996. 1997 is going to be a lot tougher to make money.
Well, you've heard everything you need to know about the stock market. Not much of a reason for us to have a conversation now, but we will do it anyway on our weekend review here on Business Insiders. It was a pretty wild and woolly week for the stock market. The Dow on the last day of 1996 down 101 points, but Friday it gained the same amount. So by and large, the week was a wash, but there are still some interesting cross currents and trends to discuss. And to do that on Business Insiders on this Friday evening, we are joined now by Phil Rettew of Merrill Lynch, a technical analyst who follows the stock and bond markets there. We're also joined by Bill Meehan, who trades bonds for Prudential Securities, and Maureen Allyn, chief economist at Scudder, Stevens & Clark, and our own Bill Wolman, who's here, chief economist at CNBC and Business Week magazine. Thank everybody for being with us. And Bill Wolman, I'm going to start with you because even though everything kind of worked out at the end of the day on Friday, Business Week did, in an outlook column, raise the hackles of bond traders by suggesting that the Federal Reserve in early 1997 is going to raise interest rates because the economy will be stronger than people think. What's that all about?
Well, first let me say, if you know Business Week, there's not exactly Business Week. Just as there's not really CNBC, there's Ron Insana, and there's Bill Griffith, you know, and there's Mike, and there's Joe Kernan, and there are various other people around. This particular thing appeared in something called Upfront, edited by a man called Larry Light, a very experienced journalist, and it contains a series of predictions about what's going to happen in 1997, of which there's a tiny prediction saying the Fed's going to raise rates twice. I mean, some people Business Week think rates will go up. Some people CNBC think rates will go up. Some people think they'll go down. So I wouldn't take this piece as being Business Week's point of view. That's all I've got to say.
And it's also not necessarily the inside dope from the Fed or anything.
Absolutely. Okay. This is just a series of. That's absolutely correct. That is not a reported column in that sense. It's just a series of predictions, some of which are, you know, for example, that Newt Gingrich will not survive, that the president will be impeached. You know, a few little things like that.
That's right. And aliens will visit the United States.
That's exactly right. Okay. So it's not, you know, a heavy-duty reported piece. Okay.
So Maureen Allyn, let me ask you about the interest rate climate before we get to the financial markets. Do we know anything new about the economy this week? There were conflicting pieces of data. The bond market was unusually jittery for the type of information that we got. What's going on?
Well, I think not unusually jittery. The bond market gets really spooked by any sense of growth. My own reading of the generally stronger tone, at least to the production side of the economy, is that surprised many people were actually building inventories to make up for sort of the sales burst that we had earlier in the year. I think that sets us up for a slower 97, not a momentum going into it, because I think those inventory levels are going to prove to be excessive. I don't expect that the Fed will be raising the interest rates. I think they're on hold. It's not as far out as aliens visiting the U.S. I mean, it has a higher probability than that. But I don't think, we're not looking at it as very likely.
Now, by the same token, before 1996, we thought there was never any life on Mars. We'll come back to that some other time. Bill Meehan, you stood in the thick of things in the bond market this week. And when I said unusually jittery, I mean, a lot of the data were not so strong that they would suggest an imminent breakout in inflation. And yet, on a couple of different days, the bond dropped more than a point. What did you make of the action?
Well, not to correct you, Ron, because I've never seen you wrong on TV before, but
except for today.
I'm not a bond trader. You probably got a lot of people at Prudential Securities very nervous. I'm a market analyst at Prudential Securities. I shudder to think about trading bonds, but the bond market is calling the tune, obviously, although we managed to disregard the bond market giving back some of the gains this afternoon. And I think it's something that we saw a lot of last year, where the market reacts to individual numbers. We've got a couple of numbers in a row that shows the economy is maybe a little bit stronger than people had hoped it would be, especially those people in the bond market. But I think we'll wait and see, and the numbers will come out, and we're probably not as strong as the market is fearing right now.
Now, Phil, sorry about that, Phil, by the way. With respect to the stock market, it was a very noisy week. Technology stocks were weak in the first couple of days. They bounced back by the end of the week. The market itself down 101 points on Tuesday, up 101 points on Friday. We know we have to get used to triple-digit swings because they're a smaller percentage than they used to be. What did you take away from the whole week when all was said and done?
The operative word there was noise. Yeah. I think there were a lot of what I call cosmetic transactions, which are, you can't prove it, but you can't disprove it either. But if you just think about it for half a second, you've got portfolio managers who are under tremendous pressure to perform. And perform can mean any number of things. You know, how the next guy do, to what the boss thinks, to what do the clients think. But it's a very real phenomenon that occurs. It's just a question of the degree. So I suspect that prior to year end, after a pretty good year, and dragging in some people who may not have participated, there was some change there. Let's take it while we got it. They knocked it down before holidays. And then coming back in, there was just as many people on the sidelines said, gee, what a bargain, you know, haven't been in for a while. So they step in and pick up what the other guys dump. And lo and behold, there's no tremendous conviction, obviously, or it wouldn't have done the down and back up. So I think we're dealing with a market that is still pretty much in the same state of affairs. It's a little later in the game. I don't know which inning we're in, but it's beyond the ninth inning.
We're beyond the ninth.
We're beyond the ninth.
We're
inning.
in overtime.
We're in extra innings.
Is it sudden death?
No, I don't think it is. So, in answer to your question, I think there was a lot of portfolio shuffling that might have disguised what's really going on.
Yeah. Now, Bill, in fact, interesting, in addition to Phil, Art Cash and Payne Weber made a similar assertion to me on the phone today that, you know, if you are driven by performance goals and you see the market down 101 points on Tuesday, it's almost a no-brainer given the behavior of the market recently to try to clip a couple percent here, just you know, hoping for a bounce back. Is that the type of game that's going on at the moment?
I think it is to a certain degree, but I also think the day we had the market down 100, you had the broader market perform fairly well. The Russell 2000 had a positive day, the NASDAQ was positive on the day, and the market was still relatively thin, you know, using my very sophisticated subway survey. There were empty seats on the subway. It means that not everybody was participating, not everybody was playing, but you're right. It has been a successful strategy to buy the dips, and I think it's probably going to continue to be a successful strategy.
You know, Bill, when you take a look at the market, okay, we've agreed that there was a lot of noise this week. It is almost impossible to divine a message that would tell us about where the economy goes from here. Bank stocks down, aluminum stocks up. That should say the economy's picking up. Gold craters to $362 an ounce this week, right, which says no inflation. I mean, where do you derive any good clues as to what's happening in the overall economy now?
Well, I think it's very hard to do that, and I wouldn't even try. As a matter of fact, I never have tried. I mean, it's not the way I forecast.
How do you get to be chief economist?
not using the stock market to forecast the economy, yeah, although it's not terrible either. So I just don't read. I don't read anything into it. As an economist, I can say I don't see any real instability this year. I think I agree with Maureen. I think growth's going to slow down, but not tremendously. I don't think much is. I think we're still a fairly stable economy. So I can't see the market. I can't see it cratering. I mean, I can't really see it either bouncing up a lot either. So I'm sort of in the middle with everybody else. You know, 5 to 8% up this year, and that's what I would say.
Now, Maureen, it raises an interesting point because if you looked at the performance of the stock market in the last 2 years, it was the best showing since the 1950s. And during that period, many folks tried to make the claim that we were back in the 1950s economically. Can you bear that out by the behavior of the markets and by the fact that the economy is not doing too much on the upside and not too much on the downside?
Well, our long-term outlook says that we're in the 1870s, the 70s, but the 1870s.
There was a panic in 1871,
yeah, there's a lot of volatility in that. But we think that one of the reasons things are so conflicting is that you're heading towards deflationary growth, where prices are down but growth is up, and you're transitioning from an economy that was viewed as one sort of thing to an information economy. And I think this is a lot of turmoil. So I would say investors should stop looking at the daily numbers for clues, try to sit back a little bit more and see where they want to be for the rest of the millennium.
I can't resist asking this question. It really got me now.
I wish you would.
The 70s and 80s
left.
The 70s and 80s, 1870s, were a great period for the American economy.
You bet.
Were they a great period for the stock market as well? The
Very
American
volatile.
stock market, very volatile.
Very, very
Did it
volatile.
end at 20 years much higher than it?
I think so, but it was very volatile, and it's hard to say. You know, there was much less in the market then.
Because it was a great period for the American
yes,
economy.
it was.
Yeah,
If I
and
recall, I don't think we had to pay taxes on our capital gains.
no, we did not. So it's back to the future with any look at all. We're going to take a break on that note. When we come back, a more deconstructionist work on the financial markets, and we'll go through 1880, 1890, 1900. We'll do it all before we finish up the weekend and, in fact, the millennium in review. Stay with us.
Some of the biggest talk on Wall Street isn't what stock to buy, it's where to buy it. On a trade of 200 shares at $25 a share, Waterhouse Securities charges just $35 in commission. Merrill Lynch, $129. Charles Schwab, $89. Quick & Riley, $60. In fact, Waterhouse saves you 70% across the board from current stock commission rates. Call this number now for a free brochure comparing rates and services. We'll execute your market orders as fast as 6 seconds. Provide free S&P stock reports. 500 no-load mutual funds. We're a member of the New York Stock Exchange, serving over 500,000 customers in over 90 offices nationwide. And when you open your account, you'll receive free this S&P stock guide, profiling over 5,300 companies. So before you buy your next stock, think about where you'll buy it. Call Waterhouse. Get your free brochure comparing rates.
Thank you for watching, and remember to like, comment, and subscribe.